stakeholders have read and reread the fine print of the cabinet approval to the changes in foreign direct investment in India's construction industry. The right time is now to ask the big question. Will easier FDI norms in construction create a housing bubble, or will they meet the government's objective of creating more affordable housing? Which way are the odds stacked? Let's thrash that precise question with our panel today. Gitambar Anand, CMD, ATS Infrastructure Limited and President-elect FDI National. David Walker, Managing Director, Sari Homes. Ajit Krishnan, Partner and Leader, Real Estate Practice, EY. Sameer Jasuja, CEO and Founder, Prop Equity. Also joining us from the Mumbai studio, PS Jayakumar, MD, VBHC. From Bangalore, Joe Verghese, Managing Director, Colliers International. And from Pune, Lalit Kumar Jain, CMD, Kumar Urban Development Limited and Chairman, CREDAI. The fact that we have people from across the country joining us today, developers and of course other stakeholders, means that there is a lot of excitement at least around this decision. Now, 100% FDI in township and housing and construction was approved in 2005, but under certain conditions. Now, these conditions have been made easier. A, the minimum built-up area requirement has been reduced to less than half. The capital which the foreign investors need to bring into the country for housing and construction has also been halved. And C, exit norms have been made easier. Government's intentions are very, very simple: to boost fund flow into the cash-starved industry, to enable the creation of more affordable housing and stem the proliferation of slums and, of course, also around cities. The first question, Gitambar Anand, tell me, norms made easier, FDI should come in. That's what everybody is assuming. So I'm going to take step by step. Minimum FDI requirement reduced to 5 million from 10 million. So this is an absolutely plus point for the industry.
That's very, very right, Manisha. Not this. You know, the biggest thing is that the minimum area requirement has been reduced from 50,000 square meters to 20,000 square meters. More so for projects which have at least 30% of affordable housing defined by government. There is no minimum area requirement. So this is a great step forward. And, you know, the entire host of opportunities now available to the FDI partners are unthinkable, unimaginable, and this is where they should really come in aggressively and invest in this country, in the story, in the growth story of India. Having said that, what needs to be, there is a lot of excitement in the market, and we can't thank the new government enough for getting in these changes, because had these been done earlier, maybe 5 years ago, we would have been in a different place today. But having said that, again, let me again thank the government on behalf of all of us here for having done what they have done.
Okay. I think Mr. Anand has been too nice to the government. David Walker, you have to tell me that this is too small a beginning, or the article that I read, you wrote after the FDI norms were eased out, said, hey, look at India's ranking in ease of doing business. So this is just a tiny, tiny step towards actually getting FDI in, isn't it?
Well, I think the first thing is it's a step in the right direction, and we should always welcome and congratulate that. And I believe FDI is very good for the country. So anything that's easing up norms in that respect is welcomed. But if you consider, you know, the requirements of India in terms of its infrastructure and its development needs, there's figures of about $1 trillion of investment required in the next 5 years. I think reducing an FDI requirement from 10 million to 5 million is not fundamentally going to change that. There are other things with the reduction in the area and making exits easier, which we welcome. But I think there is much bigger challenges that are facing. And yes, I've talked about the ease of doing business. And I guess that report is a little bit out of date, so it doesn't really reflect the current government's performance. But questions about enforceability of contracts and getting permissions rank, you know, really lowly in world ratings, around about 180 out of 190 countries in the world. Okay. So I think these are areas which are often debated on this show, but I think they're really important that they also start to be addressed as priorities moving forward.
All right. Okay. So it's a welcome decision. Now, Lalit Kumar Jain, let's take point by point on all the arguments that I've been hearing. The first argument that I've heard is that it will ease the cash-strapped industry, the cash flows. The FDI will also result in trimming of debt of several listed companies. How true is that?
I think we should be very careful when we say that this is going to make a big difference, because what changes have been made is going to benefit prime city projects, smaller ones, and larger projects in smaller towns. So what we see here is definitely increased inflows through FDI in smaller projects. However, let us not expect it to be a game changer unless, like David said, that we need mega steps in improving our ease of doing business. One more aspect which is missed out, or it may be corrected in near future, is the commencement of investment or commencement of date of operation is defined as the first within 6 months of first plan approval.
Right.
I think this may be a roadblock, because this can actually see reduction of investment instead of increment of investment. So I suppose this is a mistake, and it may be soon corrected, because currently we see FDI coming in at various point of time, and previous definition was commencement of business. Now it is commencement of project, so it will be a big dampener according to me.
Okay.
And it will not only affect the smaller investment which is envisaged, but larger investment also.
Okay. Ajit Krishnan, that's exactly what I wanted to ask you. You know, why is everyone so excited? Stock markets gave a thumbs up and all the listed companies went up. The stocks reacted extremely positively. When the fine print says that, okay, the money has to come within 6 months of commencement of the project, as Lalitji just pointed out. So pretty much it is for new projects, for existing approved.
6 months of approval of plan, within 6 months of plan approval.
All right, so then
where
will the money come? I think that's the big question. So investors, I also read another argument which is completely puzzled me, is that investors or buyers who've already bought into projects which are delayed for several years will now have a way out, because FDI will come in and help out all those cash-strapped investors. Is that correct, or that just sounds too far-fetched?
No, I think we need to really break this down into two different parts. Let me address the point of 6 months of commencement of or getting the final approval. I think the larger issue, which is what most people advocated for, was that historically there was a view that had been propagated for many years that if an FDI has to come, it has to come at a greenfield stage, which means just land and nothing beyond that. So any project which goes through a life cycle of 3, 5, 7 years, typically the large question was, can the same investor put more money after the 5th year? Because now the land is not land, it's got a semi-constructed building. Similarly, if there was a project which was half complete, it was probably going into CDR and you needed a new investor to walk in and take on, then that capital could not be accessed because this was no longer a greenfield project. What they've landed up doing is now they've added that definition to that definition that FDI can come in up to 10 years or completion of project, whichever is earlier. In some sense, they just expanded the sphere of greenfield to that extent. I think the second point that's been really made is the exit opportunity. The previous policy of 2000, 2001, 2005 never prescribed an exit mechanism. The moot exit mechanism in 2005, which was assumed, was completion of project. But what this has now done is defined that completion of project as provision of basic trunk infrastructure. So to that extent, I think a lot of positive feed saying that at least there is a clear path to exit, and there is now a lot more clarity on what constitutes greenfield.
Okay. Mr. Jayakumar, what's your opinion? What happens? I mean, if it's really going to ease fund flow, but to whom is the big question? FDI, will it actually ease out the liquidity crisis which is being faced by listed companies? We'll come to the affordable housing question much later, because that's a whole other gamut that we have to, of course, slug out with you.
No, I would go with what Lalit has said, which is that the provisions seem to suggest that existing projects cannot get financing, or so it seems. And in general, if you want to get immediate investment, you need to make sure that the existing projects get funded, they get completed. To that extent that, I mean, unless there is some other clarification, that seems to be the limitation.
Okay. Joe Verghese, your opinion on where will the monies come in?
In my opinion, we should just look at these steps as steps in the right direction, as David just pointed out. In my opinion, this is not going to open up the floodgates of funds coming into the market. I think we have some time to go before that. The investors are going to be watching and seeing that, the bigger risk, which is exchange rate risk as well as execution risk, which stands out in the market, which to a great extent is caused by delays in approvals and permissions that need to be got. All those, how is the government looking at addressing that? I think it gives a very positive signal to investors that this government is really interested in getting foreign funds investing in this market, and they'll be watching to see what next they do to make it much more investor friendly.
Okay, so we've busted the first myth that the monies, or at least debt-laden companies who have been dealing projects, they are not going to find an immediate cash infusion into those businesses. Okay, let's look at the second one, and I'm going to toss it over to Samir for his opinion and analysis. The reduction of minimum requirements for built areas and capital will now allow investment to flow into South Mumbai or Central Delhi. This will also encourage the development of smaller projects, especially in urban areas where the availability of land is limited. Samir, how true is that?
I would agree with you there that, private equity money, a large part of it has still been coming in as structured debt. Because the projects were of much larger sizes, the execution risks were much more. With this new rule coming out of 20,000 square meters, the execution risk becomes much lower. You can probably see more money coming in form of equity than in form of structured debt, because the risk will come down much below the risk of investing in a project of 50,000 square meters and above, and plus the exits have become much more easier. So I think keeping all these factors in mind, you will definitely see more private equity money coming in, but in smaller towns, you could see more money coming in places like Pune or in Bangalore or in Hyderabad, where the plot sizes are much smaller. But you may not see that happening in a Noida or a Gurgaon, because the minimum size is anyway 11 acres odd. But yes, I completely think that it will open up many more avenues for development in smaller land parcels in urban areas and in smaller tier 2, tier 3 cities as well.
Okay, Gitambar, would you agree? I mean, PE investors, whenever I've had them on the show, say, look, we don't think these markets are ready right now. The demand there, the job creation is good enough for a robust housing demand. So if PEs are not investing, why will FDI or foreign money come into tier 2, tier 3 cities?
See, we have to look at this whole issue in two parts. One is the central government has done their bit by showing the intent to be business friendly and friendly to the foreign investor by making rules which are conducive to investment. The other part is, will money flow in? See, yes and no. Now, as an investor, if I were a foreign investor, I would look at the world rank ratings of ease of doing business in India. That's 142, sad story. But again, over there, the central government is pushing for a system of a single window clearance. These things take time. They will happen when they happen. The third part of the story is, which everybody's touched on, that is the execution capability of the Indian partner. Now, unless and until the foreign partner, the foreign investor doesn't get comfort about his partner over here, whether he can actually execute and deliver a project, be it 20,000 square meters or 10,000 square meters in affordable or whatever, you won't see money coming in. So from our end, from industry, we have to focus on construction, on execution, and we have to show that yes, we can do it. Because there's a documented shortage of housing in this country, be it in the space of middle-class housing or affordable housing, there is a shortage.
Okay, sure enough.
So the opportunity exists. The central government has gone ahead and made certain changes in the law so that foreign investors can come in. State governments need to now make the approval process more streamlined. They need to really aggressively think about how...
Okay, Gitambar, am I hearing that the reason why PE funds haven't gone to tier 2 cities is not that there isn't money to be made in housing in tier 2 cities, but because of the approval delays and the complicated approval process? Is that true? Because I'm hearing a very different story.
No. That is true not only for tier 2, tier 3, that is true for tier 1 also. You know, they're so scared of the approval process, they say, they would be happier coming
Okay.
into a project which has sanctions, and that's what we've been experiencing in our dialogue with these foreign partners.
So you're saying that the debate is mute whether it's a large city or a tier 2 city. Right now we have to fix the process, the execution track record, etc. All right. On the execution track record, more FDI. Now this is another interesting aspect which I read, which I totally actually think could be very true. More FDI would also mean that builders would have to adhere to the international norms and will be forced to be more transparent in the way they operate. Ajit Krishnan, that should be true.
Yeah, so I think if you...
But it still hasn't happened. I mean, there has been FDI, but how much of that has led to transparency is a question.
Yeah, so I'm an ever optimist. I think the point is we have to get real, and we have to also try and do it in relative terms. So if you look back in 97, what was the level of transparency this sector in this country had versus 2003 versus 2013? I think there's a lot more clarity, there's a lot more information, there's a lot more blogs, if you may say that. There's just so much more information flowing out there.
Okay.
So just knowledge, I think, has changed dramatically in the last decade. Now, well, I won't say it's purely because of FDI as a character. I think it's just the way the country's moved, the way real estate as a sector has moved, the way there has been an emergence of players, not just in the tier 1 cities. You had, Sare Homes was not a name that you had heard of, right? It's emerged as a great developer. There are a lot more professionals getting into this business across all cities. I think the challenge which Gitambar pointed out on execution clearly remains. It's not just about the developer, but also the entire ecosystem of the construction industry. The second is, I think when you looked at tier 2 and 3 cities, we as a firm are of the view that there is clearly a large opportunity out there. However, you just don't get to lay your hands on an organized player. It's largely fragmented, one-man ownership, not too many organizations, pretty much operating on single projects of small, very small scale, small size. And FDI capital, so it's not FDI, even domestic capital doesn't go into those cities other than for mortgage. So, if you picked up all the banks in India and said, how much of money, equity money have you actually lent to a tier 2 and 3 city, it will be abysmally low. They would have definitely lent against mortgages, home finance, construction finance. But, if you ask them what is the nature of security they believe, what is the credibility they have of a tier 2 or 3
I think that will change now, I think.
And that's the
it's
move
evolving.
point. And FDI capital is nothing but a source of equity. It has to start as a stimulus of equity. And unless it starts as a stimulus of equity, structured finance and all that is for more mature markets, maybe the tier 1 cities which have matured into that. But they also went through a role where they had raised a lot of equity and then they matured into a structured finance product.
Okay, I think, Ajit, you've raised a very interesting point. FDI is equity money, but how expensive or cheap is it going to be? I mean, will it make money more expensive rather than cheaper? Even that's debatable. At what cost will FDI money really come into housing and construction? When we come back, we're going to look at that.